Okay, awesome. So welcome everybody. This is the ClinX Academy office hours. I'm Alex, and we are joined here today with Arvin Grover, who is the founder and general partner at DHVP, Digital Health Venture Partners. And we have some additional folks coming in here. So in full disclosure, I am an investor in DHVP and an advisor. I believe, Reza, you are too, right?
Me too. Me too.
Yeah.
In Arvin, we believe.
Yeah, in Arvin we trust. So I wanted to invite Arvin here today because when I first met Arvin, I don't know, maybe around a year and a half or 2 years ago, whenever it was, I remember we were in some random guy's backyard for like a health tech happy hour, and I met him, and I was instantly pulled to him by his depth of knowledge of the healthcare space and the depth of analysis he was doing on deals, which seemed so much more nuanced and thoughtful than anybody else I had met in the venture space. And since that time, we've become friends. We co-founded a company called DeckDrop. Reza and I have invested in his company, and we help advise Arvin on some of the deal flow that he has coming in. And anyways, I'm honored to count Arvin as a friend and colleague. And so, Arvin, I'm going to pass on to you to kind of introduce yourself.
Yeah, no, thank you so much, and hope I can live up to the kind words. So yeah, my quick background. It's nice to meet all of you today. I run a venture firm called Digital Health Venture Partners, as Alex mentioned, and we are a strategic commercialization partner for early stage technology companies. So really what we're doing is we look at software and AI enabled services in a variety of end markets. So we look at companies selling into health systems, hospitals, provider roll-ups. We look at companies selling into health insurance, self-insured employers, companies that are actually helping brokers make better decisions. And then we do a lot in the post-acute home health space as well. And part of our value add is some of our backing comes from, in exited founders, physicians like Alex and Reza, private equity firms that have portfolio companies they might own outright that are looking to figure out how to embed software in some of these legacy services businesses. And then we have executives across the continuum that are, working at large healthcare organizations and leading these organizations as well. So our whole goal is to be able to help the companies grow because I think execution is the name of the game today. I think technology is becoming less and less of a moat, and it's really about how do you help find inroads to the right partners to help scale these businesses at a rapid clip. And that's something we're very thoughtful about. So what we like to do is in our diligence process, we will actually bring in people like yourselves on a sector by sector basis and say, okay, let's help vet this technology before we're making an investment decision. Let's talk to the buyers. Let's see what the buyers have to say. What are they using today? And how is this solution better, if at all? And is this going to make you, go faster, deliver better outcomes, or reduce costs for you? And that's really the most important thing today. So we kind of do that vetting on the front end, and then on the back end, we will go out to that same group of people and help with commercialization and sales and say, hey, you looked at this on the front end, you told us this was a good decision. Do you want to buy this as a product now and use this in your organization? And we've had a lot of success doing that. And I think that kind of going deep and understanding from a granular level as to where the value add, where the ROI is, has been very impactful for our portfolio. We have 10 portfolio companies right now. And, prior to founding this firm, I ran the venture arm for a national health insurance company called Commonwealth Care Alliance that was acquired by CareSource. And then before that, I worked for more of a private venture firm, but we were backed by regional health systems. So groups like Honor Health, Hartford Healthcare, Guthrie Clinic, and groups that didn't really have the scale or expertise to have an in-house venture arm. They'd outsource that function to us. And then prior to that, I was an investment banker, covered services companies, and then started a billing company in between my banking time and my venture time. So that's a quick background on myself, and it's nice to meet everyone and happy to answer any questions on that.
Arvin, one of the things, we've all, Alex and I and everybody else has talked to a lot of early stage startups over the last 2, 3 years. The ones I talked to 3 years ago, the large majority of them have gone under. So walk me through what your expectations are. Like, what is normal? What is like a little bit better than normal? And like, how do you decide to put some bets down if the fail rate of these early stage companies is so high?
Yeah, it's a great point. I think what the statistic is now, probably upwards of 90% of startups fail, and I think that there's good reason for that. And I think what we've been pretty careful about is making sure that we're investing after we've seen some initial product market fit. And I think people have a lot of great ideas out there. Their technology can solve a lot of problems in healthcare today, but it's really about the go-to-market strategy and how to reduce friction. And I think there's a lot of friction in healthcare. Like, try going into a big hospital and telling them you have a better mousetrap for billing. They're going to laugh you out of the room and just tell you that we've got a pretty well-oiled machine here, and we're not going to switch out to a startup. And I think that's really where you've got to do your homework. And so I think where our approach has been, pressure testing and validating. Okay, do you have some existing proof points? Have you sold this solution to customers? And what's the customer getting out of it? And if there's not a clear answer to that, I think that's a good reason to walk away out of the gates. I think if a company doesn't necessarily have that in place, it's not saying that you can't make an investment. I think the ways to de-risk yourself there are actually going out and finding some buyers. Sometimes those buyers may not want to talk to you unless you pay them, and that can be challenging. But I think more often than not, you'll be able to talk to someone who's an expert or a potential buyer for that solution, and you can start to get some good feedback there. And I think understanding the competitive landscape is probably one of the most important factors and things you can do. It's actually why Alex and I built Dextrop, is to go out there and help find competitors for startup companies, because there's just so much out there right now. And I think by doing that, what that does is it lets you know who else is in the market and who your competition is. And do you have a better mousetrap than that person? You don't necessarily have to out of the gates, but it tells you who your competition is. And if someone else has additional proof points, if they have case studies, outcome data, those companies are going to have a lot easier time selling into those environments. So I'd say looking for that initial customer traction is very important. And then the next step is, after you have that customer traction, is that company working towards publishing some data, whether that's a simple white paper or a full-on case study with that end customer. But it's important to articulate early on what the value you're delivering is. So it's typically one of three things. It's cost reduction, it's improving outcomes, or improving the experience overall, and taking away that friction. And I think that's sort of how we've been able to cut through the noise, and try to find companies that are going to really build for scale and stick around for the long term.
I think there's one more element that Arvin, that I've seen you do that really kind of is differentiated from others, and that is, I think in your consideration, you ask yourself to what degree you can help the startup expand, go to market, basically, right? And do you want to share? I think you had a recent huge win in that. If you want to share a story.
Yeah. So we always think through our network, and that's part of the way we sell ourselves to companies. Like, if there's a really competitive round and there's a lot of people that want to get allocation into a deal, one of the points that sets us apart is how we can be helpful. And if we can be helpful, and our partners get excited about something, it gives us more confidence, because we know you're going to get some revenue milestones. We can help you do that, and at least we'll help you make it to the next financing goal. And ideally, we can get you enough revenue coming in the door that you can start to normalize the cash flow and not be bleeding cash to a high degree, but you're kind of becoming more capital efficient with some cash coming in the door. So, with our private equity relationships, I'd say one area where we have a ton of connectivity is in the home health hospice space right now. And so, as you'll see, there's got some legacy EHRs in that space. You've got your home care, home base, your WellSky, and they haven't innovated in years. And so everyone's out there figuring out how do you plug in AI and supercharge this archaic workflow and make it easier for providers, reduce clicks. And so I think in that vertical, we probably have 4 investments now, all at different points of the workflow. But essentially, what we're able to do there is exactly what I described earlier. Is before we make an investment, we can go out and figure out, hey, is this a pain point in your workflow? Does this kind of create friction in your environment? Are you spending more dollars than you want to here? And if you are, like, let's demo this solution and this product and figure out if this would solve your problem. And if it does, sometimes we've even gotten commitments from these groups to say, we're going to become a customer of this if you invest in it, or even if you don't invest in it. We want to be a customer here. And that gives us a lot of confidence when we're making a bet. And then it also positions the company very well, because we're making an investment, and then within a matter of months, we're signing deals, we're getting customers onboarded, and then we're publishing that data and using it to go around to other customers similarly. And then if you do a good job for these customers, they become your ambassadors without even asking them. They're going to go tell their peers in the market, we're using this new solution, and it's just amazing. And it's really saving us a ton of time. And I think people talk, and so that's kind of something that we view very favorably, is if we can actually bring some customers to the table, we're de-risking that bet even further, and it's not a black box. We at least understand, all right, we know what's going on with a certain channel and a certain account, and we can actually turn that revenue on, and we can also go have conversations on behalf of that company and say, okay, if this company's coming up short in some area, like, what do you need to see for us to fix it? And we can work with the business and kind of bring that comfort to really get them and secure that deal. So that's something we do a lot of, and it's been very impactful for our strategy.
I think it's unbelievable. I mean, I was just talking to Arvin the other day, and so there was a startup that wanted to sell something to the home health space, right? And so Arvin connected them to a bunch of home health agencies and said, basically, pitch them. I want to see if they're interested, and if they are, I'm going to invest. So like it's brilliant, and it's kind of it's actually quite simple, but so many folks don't do that, or they don't have the network or depth that Arvin does. So why don't we change gears a little bit, Arvin, since the focus of this is like what the physician role in venture. Can you talk to a little bit about the various types of roles that physicians play in venture, and your thoughts around all of that?
Yeah, I think there are a number of roles. I think it's number one based on interest, and two, capabilities also play into it. I think the number one thing investors like myself get out of, like, the main value we get out of working with physicians is know-how. I think we're not running the day-to-day businesses in the weeds. We're not delivering care. And I think that's really important, because when we're trying to figure out how to automate a process, we want people who have know-how. We want to understand where I talk about friction a lot, right? I think, like, that's the whole point of AI is how do we reduce the friction? And we can't really understand how to automate a process if we don't understand where the friction points are and where the pain points are. So I think a lot of your day-to-day pain points become the problems that we want to solve and go out and find solutions to in the market and actually build. And so I think where you physicians can be the most impactful is what your day-to-day workflow, like knowing the ins and outs of that, knowing who the vendors you work with are, knowing what's good about a vendor, what's bad about a vendor, knowing what pieces are missing from the process. I mean, that's gold. It's exactly what we're looking for, and I think that's probably the most impactful thing. In terms of roles that we see, I mean, there's a number of ways you can partner with venture firms, work with venture firms. One is you can be an investor. I think that gives you great exposure to the types of things investors are looking at, the types of companies they're investing in. You get a pretty broad aperture of, okay, here's 10 companies that someone just invested in, and that gives you an idea of, okay, could I use this same process or workflow but in a different sector or a different category? And that kind of gives you ideas to think through and brainstorm on. You can be an advisor to a fund. You could that's maybe a step even deeper than being an investor, where I think there's two ways to advise. One is you can advise on investments in the manner I just described, in terms of, all right, we're we're going into this very verticalized area that you might know inside and out, and then advising as to the diligence process there and helping make that go, no go decision as to whether or not you actually pull the trigger on an investment. And then there's the other piece is business development as an advisor, right? Like, I think one of the most important things you can do for a company these days is helping them sell. And it's the hardest thing to do at the early stage of a business. So do you know people in your particular, specialty that you might know? If you're a cardiologist, you know the cardiologists, for example, and you can go out there and be an advocate and a champion for those businesses. I think one of the problems we see is that when you're on the front lines, you're delivering patient care, you might have spare time, but my sense is you don't. And you don't have time to go out there and say, okay, what is every single patient engagement solution for the cardiology market on the market? I think that is where, you might work with a VC and then say, okay, you go find companies, bring them to me, and I can tell you the ins and outs of the workflow and which one's going to fit and have the least amount of friction. I think from that standpoint, that's very helpful. Beyond being an advisor to a fund, you can be an advisor to an end portfolio company. If there's an actual business in the portfolio that resonates with your skill set, I think you can bring those skills to that portfolio company. A lot of portfolio companies are happy to give advisory shares, cash compensation for fractional work. There's always ways to get involved in the business, and that's a nice way to provide some sweat equity and maybe not even put cash in, but get some upside in something cool that someone's building. And getting involved early is great because, I think that's when people need the help the most. I think you can go work for a startup. That's another way to do it, be an early employee. I think there's, at a certain point, depending on the type of business, there's always need for chief medical officers. I think you get that more so on the tech-enabled, AI-enabled services side, where you're actually doing some type of care delivery. But then also there is know-how and kind of expertise needed in some of these software businesses, especially software as a medical device. So I think those are opportunities. And then you can start a business or you can start a fund. I think those are all ways that you can participate in the ecosystem. And I'd say there's also a big distinction between kind of private equity versus venture capital. I think both are outlets and options for people. And I don't know, Alex, if it's helpful to touch on kind of the big differences there, I'd be happy to double click there as well.
Yeah, sure.
So yeah, private equity, I mean, it's more, I'm sure a lot of you probably know this, but in case you don't, really what they're doing is they don't want to see any institutional capital in the business for the most part. They really want to see someone who's bootstrapped a business, built it, it's profitable, it's making money, and they want to come in and own that business outright and then hold that business for about 5 years. And they want to make some either operational adjustments to improve margins and grow the business organically, or they want to go out and buy a bunch of other companies that can add on to that platform and then look to sell the business in 5 years. I'd say typically in private equity, you're dealing with most often larger dollar amounts. You're dealing with bigger deal sizes, bigger transactions, much more mature companies that are later stage, already up and running. It's not so much getting an idea off the ground. It's more so about optimizing an existing business and setting it up for scale. I'd say the hold periods are shorter than venture capital. Typically, you're really looking at a 5-year time horizon at the max. But you're typically dealing with less innovative companies. And so you're most likely not investing in AI and investing in high growth software companies. You certainly can. That there's an asset class of private equity that does that, but in healthcare, a lot of it is service oriented and service driven. Provider roll ups, buying out legacy billing companies, buying home health agencies, buying hospices, that sort of work. And then on the venture side, it's different. I mean, at the early stages, you're dealing with much smaller capital amounts. Rounds are $5 to $10 million at the early stages. These companies are not profitable; they're burning cash, and so you have the inherent risk of running out of money in a venture company if things don't work out. The fail rate in venture is much higher, but the return threshold is typically much higher given the risk reward. In venture, the typical hold period is probably 10 years for an investment versus your 5 in private equity. And in venture capital, a lot of it is around new business creation, ideation, going out and figuring out a new mousetrap to solve a problem or using new technology to go out and solve a problem. And venture-backed companies are expected to grow at a very rapid clip, much faster than private equity companies. So it's kind of growth. The mindset used to be growth at all costs. I mean, that has sort of shifted with what's happened in the market, but you get the idea. The idea is that you need to grow, upwards of 50% a year, ideally 20% a month, in terms of, venture capital backed companies, in terms of how fast you need to scale to go out and take the market. So, and venture backed companies will typically need to raise capital time and time again to get to a state of profitability. So it's not uncommon for a venture backed business to take 3-4 rounds of financing before they're actually profitable and able to sort of stand on their own feet. So there's opportunities in both. And it's just important to know which one you're more excited about and what you're going after.